All right. Good morning, everybody. What a weekend. It's interesting that we had an idea the VIX would start to move back up and get through that 19 level after OPEX. Really didn't know what would be the why behind it, but that was pretty much what we were expecting. And we got a Moody's downgrade. The VIX popped above 19, and here we are. NASDAQ down the most, more than 1.5%. Small caps right behind it. S&P down more than 1%, but not even at 1.25, certainly not 1.5. So little disparity between those two. The Dow down the least. So our blue chips, blue ribbon, not even at 0.5%. We're going to hear from various Fed speakers today, chipping their teeth. We have some auctions. It's going to be an all-day thing. These Fed speakers will be talking through the afternoon. And it looks like we may have something from the president twice today, including a White House briefing. So that would be 3. The time frame that you see on Finance Juice is always your own local time. So these are not Eastern time. Just add an hour to this. That would be 9 o'clock for the White House briefing, 10 o'clock for the Putin phone call, and 3 o'clock for a signing ceremony. So we have 3 different opportunities for the current administration to shake the market on top of everything else. We got Home Depot and Target this week. Those two, much like Walmart, can move the market with their forward outlook. So it's worth paying particular attention to those 2 earnings. More Home Depot, less Target, but still worth keeping your eye on it. And gold heading back up, which has really been par for the course recently. Right? The S&P down, gold up, S&P up, gold down. We did disconnect from the 10-year last week, and we can see this morning this push in the 10-year back to the upside while the ES headed to the downside with the dollar. Keep your eye on the dollar. We don't want that thing moving around too much. Either one of these, really. Rate of change in the 10-year or the dollar, we don't want to see that expand. For the dollar, let's get back below that $100 level, get back into double digits, but nice and easy, right? Doesn't matter if it takes all day to get there, just get there calmly. We are at the volatility trigger and the put wall, slightly above 0 gamma, and the ES is considered relatively bullish to have the put wall rolled up right into our system like that. But you see how close we are with the call wall too. All of our levels are just convergent right here. This needs to spread out a little bit. Wouldn't be surprised, as the week progresses that we see all of these levels get readjusted and moved around a little bit. It's just a cluster at this point. Not very helpful or useful. Dangerous, I would think, is another way to put it. The spot gamma report was done really early this morning. So if you haven't had a chance yet, check that out. They did talk about a lack of structure or a lack of support, really. Because if we have the put wall up here, volatility trigger, zero gamma, if we break all of this, which all of them are above the 10, if we break the 10-day moving average, there's nothing option-wise, there's nothing down there to really help us out. Looking at 84,000 in the overnight, so still holding into more of our normal range rather than this new normal. It's good to see the numbers getting back, to something a little more common. Closer to the lower ADR this morning than the upper ADR, which makes sense because we're down more than 1%. Generally speaking, if we get that close, we may as well go ahead and hit it, but it does lean on the idea that we got to continue drifting to the downside to get there. Cumulative delta, as I was posting a little bit ago with using the Jigsaw platform, it was bumping up just a little bit to the upside, but it turned back around again and is headed south. So that little lift on this last leg wasn't even the first one. It wasn't this one. There was a little lift in the cumulative delta through that zone right there. Didn't stick. And from a cumulative delta point of view, we're already halfway back to this low. So it's leading. So very likely we go ahead and tag the ADR half on the downside. And then at that point, depends on the market, on this Moodys downgrade and how much farther it wants to take it, to see if we can challenge Thursday's low. If we can cut through that, then we'll focus on 58.30. It's a cog line, and it's the full ADR half. Right now, we've got a 100-point average daily range. If we split that in half, it's the two red lines. But if we make the entire ADR in a single direction, then that would get us to the yellow line. Not expecting that much weakness. We could see something come out of the Fed today that can make us that weak, or just turn everything around. This is a classic setup for a TRB. So, we could flip here, run back up, tag the upper one. We would need to get an inside day breakout to tag the upper one. Not by much, but we would need it. Just like we needed to break outside of Friday's range to tag the lower one. Because Friday was just a really narrow day. Those NR days, narrow range days, often come before a big move. Typically, we get 2 or 3 of those narrow range days in a row, and then we get the big move, but whatever. We talked last week about the need for a pullback, and the idea was that we would get it when we came to the top of this range, and we didn't get it, right? We got there, we didn't pull back, we actually got above it. Now we're looking for perhaps a bit of a Busby. Old resistance becomes new support. Check that support, and then a retest of the last high. That would give us the pullback that we're looking for, the higher low. This week's channel is really big. It's a really wide channel for the week. But we are above it for the moment. So we want to continue to hold above that weekly channel. And the idea that we're really close to it, rather than starting the week gapped a considerable distance away from it, does give us room on the week to make some moves to the upside. If we started the week already gapped up, say 2% above the weekly, then it really doesn't leave us much room for how much farther we could go to the upside on the week, right? Take last week for an example. This is last week's weekly floor pivot, and we opened up here. We were already gapped up a considerable amount. Now, sure, we went higher from there, but it had already taken out some of what we could have made on the week. This week, we're starting within the channel itself. So we have the opportunity to make that run during trading hours. If we do break through the weekly pivot, target the channel on the other side, if we can get through that, then we'll look at an inside week breakout, getting out of last week's range, which would basically be Monday's low. And that gap that we left behind back there, right, between Friday and Monday, it's a little deeper than I think anybody's expecting at this point. Today's daily floor pivot is within a narrow channel. A narrow channel implies if we break out that it could stick and we could continue to run. Well, surprise, we broke out of Friday's range, and so far it has stuck and we are continuing to run. Not much of a surprise, right? But it told us that last night before we had even broke out. So just keep in mind, these channels don't make price break out. It doesn't make price do anything. Last week's profile ended relatively decent, all things considered. I would say you want to focus on this entire zone, not just that point of control. And it's what we're struggling with right now. So as long as we continue to hold within this zone, we can build out a new zone in this week. And it wouldn't surprise me if our own point of control lines back up with last week. So you can see they were working on it already. We have this high volume node right there. So they've already been building out that level. Once we've established this zone and we leave the range, if we come back into it, it will act as support or resistance, depending on which direction we leave it from. But as long as we're just holding it within it, then we can chop back and forth as much as we want. We don't expect it to be anything more than just a zone that we're holding out in. It's not a really big range either. 20 points, 5,900 to 5,920. Ten-day, 30-minute volume profile with TPO. We have the point of control up there with us. We have a really wide value area. The value area high and the value area low. Point of control. Now, as we get a new candle on the right, we will lose one on the left. We've got to lose all of these candles down here, then these ones in the middle before we get over here. You can see that that's days away, at least a week before we get to the volume that created this point of control. So the only thing that will move this point of control sooner than that is price staying in one spot and building out enough of a profile in a new location to make it move there. Now we can see the TPO's point of control is down below the value area low. But we're going to lose these candles, and then we're going to lose that point of control and see it move up here. So unless price goes back down there below 5,700 and puts new footprints in that old zone, then we don't really have a new place. We've got 5,850 that we could build out. or 59.50 that we could build out. Maybe more like 59.32 cog line. So if we do see some weakness this week back down into that 58.50, that'll give us more edge on seeing the point of control roll down 60 odd points. This is likely to turn into a P-shaped profile as we wipe out these along the bottom instead of this double distribution profile. And we move through shallow areas really fast. So if we do break 58.50, I think I agree with Spot Gamma that there's not a lot of structure down there to hold us up or help us out. Below 58.50, we've got a significant airdrop, free fall, flash crash, all kinds of fun names for that. The old VPOC from the last contract, we can finally take that off the table. We hit it last week. Surprisingly, we did respond at that level. It was a little bit of an experiment to even leave it on. You know, the old argument that old contracts have no value from a profile perspective, especially if the point of control is considered unfinished business. How can you have unfinished business in a contract that no longer exists, right? Still left it on there, just curious to see how price would react at that old level. And we saw repeated examples of price reacting at that level last week. Kind of makes the argument that the contracts that expire, their point of control, if it's a VPOC, still has weight to it, and it's worth keeping an eye on it, even if that contract doesn't exist anymore. $59.71, last Friday's point of control. We now have that overhead. And we've got a really nice double distribution this morning. TPO and volume profiles, point of control lines up really nice. That 59.32 shows why a cog line has so much value. If we can get through that, we got a speed bump getting into 59.50. Last Friday, we have this zone down here in a weird location, 59.40 area. Cut through that, we get through 50. We can challenge this VPOC, but I look at all that and ask what's going to be the driver to the upside. We've got really nothing good to kind of change this mood around. And that's all it would take. You know, if you think about the news that came out, nothing's changed other than sentiment. That's it. And sentiment can change back again pretty easy. So on Friday, we examined this week's range while discussing the idea that this week's range at the time wasn't set in stone, that it could continue to shift through the day on Friday, and that we'd have to re-examine it on Monday. Well, here we are. It's Monday. If we compare this current week's range to last week's range, we can see that the current week's range is more narrow, right? Last week's range was much wider. There's two things that make up this box. One is time, and the other is volatility. Time didn't change. We have 5 days last week. We have 5 days this week. Next week's range will only have 4 days in it, right? Because we have a holiday. So we have a short week. That will throw the math off because less days. But between last week and this week, it's a 5-day week for both. So time didn't change. The only thing between last week's box and this week's box that happens to be different is volatility. If there's less volatility, then the range is more narrow. really is about as simple as that. The math formula goes into a square root of time, and it gets a little complicated beyond that, but that's the long and the short of it. At first blush, thinking this week has less volatility sounds great, right? There's less fear, there's less angst and trepidation about what could happen this week. When we think about all the different economic events and the bricks in the wall of worry, less volatility sounds fantastic. Except big events can be volatility suppressing as we get into the week of the big event. For an example, FOMC. So if this week was an FOMC week, it wouldn't surprise us to find that it's a narrower week than last week's range, because the anticipation of FOMC would suppress volatility and we'd have a narrower range because of it. So is this week's range narrow because there's something really big on the horizon that scared investors and tightened up the volatility range, or is there just nothing to be scared of this week? If we look at what's on the economic calendar for the week, there's nothing really big that stands out, right? We do have events, but nothing that is so drastic or extreme that we would point to it and say it's very likely the cause of a narrower range. It's not Home Depot, right? That's not big enough. So keep your eye out this week. Maybe there is something that isn't showing up. A perfect example of that would be QRA. QRA really doesn't show up on economic calendars, and it's one of those sneaky ones that'll come out and smack you on the side when you ain't looking. I'm sure it's not the only one. There can be other economic events that we just don't know about because it's not very much common knowledge. So keep your eye out. Maybe we'll find a new one. If we look at what's up this morning versus what's down, gold is up, or precious metals, miners, and the VIX. That's it. Everything else is either flat, meaning not up a half or not down a half, or it's negative. If we look at the things that are flat, just to see if there's a little tell in there, bond volatility, a lot of volatility tools, which at first blush sounds good, but they just don't register anything in the pre-market. They won't move until the open. So no surprise that they're not giving us any insight. But also things like junk, which is, a bond, consumer discretionary, consumer healthcare, transportation, the China ETF. Not a lot in there for what's in the middle. For what's down, China again, financials, energy, industrials, real estate, retail, airlines, Bitcoin, consumer discretionary, technology, bonds again, Mag 7, chips, every sector and industry that we would need for a move to the upside, those risk on sectors, they're all down. The hyperscaler names that we would need to drive us to the upside, they're down too. We won't know if we have any bullish options flow until we get into the open, but why would we, right, when we have everything else that's down? It is worth considering the idea that, sure, we're down a little bit, which makes sense because we've had some really good moves to the upside, and we can't just continue to drive to the upside without pulling back at some point. In the last 5 days, tech is up more than 3%, consumer discretionary at 2.5%. We need a bit of a pullback, right? It's got a pause, digest, got industrials, which is supposed to be sleepy and boring, up 2.5%, energy more than 1%, utilities at 3%. So does it, it's not much of a surprise to see that we're pulling back a little bit now. Don't read into this that it's some kind of massive correction and we're going to head back down with gusto, picking up speed on the way back down. Nothing in the deck or in the cards suggests that kind of move back in the other direction. This is just a pause, a digestion of the move that we've already made. When we look at these moves, the things that are up or the things that are down. So chips, SMH was up more than 5%. We gave back 2 this morning, but we're still up 3.8 even after giving back 2%. So some of this doesn't look really good until you compare it with how much we were up. A 5% move in 5 days, that's a lot. We need to give a little back. So I wouldn't load up on a bunch of heavy shorts. Kind of be the takeaway. All right, nat gas and solar lead the way to the downside, but both of those are trash, so just set it aside. Once you get those out of the way, we got chips and then Mag 7 and bonds as the next ones in line. Now, DBC is more of like an ag, so it's calling it commodity. Maybe DCA is ag and DBA is ag and DBC is commodity. Either way, these are really thin, and most of the time in the pre-market, they barely leave any footprint at all. So it's showing it way down here after, closing on Friday up here. We need more out of it than that. That's not enough. So sure, it says it's down, 2%, but let it get into the open and show us that it's still down that much. Otherwise, it's very likely that we find it popped back up again. We see that before in other versions, right? Look back previous weeks, previous days. There was an algo print here, for an example, way up here. So you would have thought on that morning, oh, it's crazy bullish. Nope, it opened back down here anyways, right? So kind of the idea. That little algo print this morning doesn't mean anything yet. It needs to build out some candles first before we start to trust it, like bonds did. We're getting new lows in bonds that a lot of analysts said was off the table, that, the low was in, we were done. We're not going to go lower than that. Yeah. Surprise, we went lower than that. So they'll have to get out the tarot cards, I suppose, and figure out a new level lower. For everybody else who doesn't do it that way, just measure this range and project it to the downside. 111, 1236, 1.5, 2.0. See where we're headed next in bonds. Got a really nice short setup. Just be mindful of the double bottom versus the inverse cup and handle logic, right? Inverse cup and handle should bounce on the previous low, give us that cup, which is what we had. Right, that was the low. That was the bounce. So there's our cup upside down. There's the handle. There's the play. The only thing about that argument that I don't like is the handle went farther back than it should have. If it had stopped right there, things would have been fine. And then it would have fell back down. It'd have been perfect. But it didn't do that. It set a higher low and then a higher high. And now it broke. So it kind of screwed up the whole pattern. Calls into argument whether this is going to play out as an inverse cup and handle or not. So that's what I've got this morning. It doesn't look like we got any surprises tucked away here. Should be a fairly simple day. We got to get back in the box, which is Friday's range. Otherwise, the expectation is that we just stay inside of Thursday's range. There's plenty of movement between Thursday's low and Friday's high. That's the box because we're already out of Friday's range. So we have all of this from Friday's low, Thursday's low. Stay inside of that. If we do break back inside of Friday's range, then we have that as well. It's about a 100-point move between those two. 59.70 to 58.70. There's your 100 points. Plenty of room to just chop up and down and really not go anywhere. And set us that higher low that we're looking for. 58.29 is the 10-day moving average. Be nice to get a little bump off of that. That would be a perfect reset like we had back on May 7. If we do break Thursday's low, well, by that time, we'll very likely already be in the trading session. So I'll post updates of the charts with new targets lower if we happen to get there. Right now, if we break our own Globex low, that is the target. So from 58.92 to 58.70, it's not bad. 22 points, 8 to 10 contracts. That'll finish your week off relatively nice, and it's only Monday. All right, everybody. Be careful, be safe. I'll see y'all tomorrow.